While most investors are distracted by stock market headlines and short-term price movements, something far more important is happening quietly beneath the surface. Silver, a metal often ignored and misunderstood, is sending a signal that historically appears before major shifts in the global financial system. This is not hype, and this is not a price prediction. This is a signal-based macro analysis, because when silver starts behaving differently, it usually means stress is building where most people are not looking. Most investors think of silver as a cheaper version of gold, but that assumption is incorrect. Gold is primarily a monetary asset, while silver exists in two worlds at the same time. It is both a monetary metal and an industrial necessity. More than half of global silver demand comes from real-world industrial use, including solar panels, electric vehicles, military electronics, medical technology, and advanced manufacturing. This makes silver extremely sensitive to economic pressure. Gold reflects confidence. Silver reflects stress, and when stress builds quietly, silver often reacts before the headlines change. One of the most overlooked issues in the silver market is supply. Silver is rarely mined on its own. Most of it is produced as a byproduct of copper, lead, and zinc mining. This means silver supply does not respond quickly to rising prices. At the same time, global silver production has not fully recovered from pandemic disruptions. Major producing regions face labor shortages, environmental regulations, and political uncertainty. New silver discoveries continue to decline year after year. Silver cannot be printed, and it cannot be created by policy decisions. When demand rises faster than supply, the adjustment does not happen slowly. It happens suddenly. Central banks do not buy silver directly, but their actions strongly influence its role. Record government debt, persistent budget deficits, and long-term currency debasement push investors toward hard assets. Gold usually reacts first because it is conservative. Silver reacts later because it is volatile. But when silver finally moves, it often moves faster and more aggressively than gold. Silver tends to perform best, not at the beginning of uncertainty, but when confidence starts to fracture. Silver price movements are driven as much by psychology as by fundamentals. This is not about specific price targets, but about behavior. Silver moves in long periods of compression, followed by rapid release. For extended stretches, it appears quiet, boring, and forgotten. Then suddenly it accelerates. In the inflationary period of the 1970s, silver multiplied rapidly. After the 2008 financial crisis, silver outperformed many major asset classes. These moves did not begin with excitement. They began with silence. Silver does not warn loudly. It whispers. Most market participants are exposed to silver through paper instruments such as futures, contracts, and exchange-traded funds. Physical silver operates differently. When stress enters the system, availability tightens before prices rise. Premiums expand before charts reflect the change. This divergence between paper pricing and physical reality is often one of the earliest warning signs of deeper market tension. Experienced investors do not focus only on price charts. They watch delivery stress and supply availability. Silver is not without risk. Short-term dollar strength can suppress prices. Liquidity shocks can force temporary selling. Risk-off environments can create volatility. Silver does not move in straight lines, but volatility is not weakness. Volatility is information. It reflects uncertainty, leverage, and pressure inside the system. Right now, silver is not screaming. It is whispering. And historically, whispers come before storms. This is not about fear or speculation. This is about positioning and awareness. The real question is not whether silver will move, but when the broader market finally notices what it has been quietly signaling all along. Hey everyone, welcome back to the channel. Today, we're diving deep into the world of silver. It's not just a shiny metal. It's a fascinating asset with a lot of moving parts. If you've been watching its price lately, you know it can be a wild ride. So, what's really driving the silver market right now? Let's break it down into 4 key areas: currencies, interest rates, industrial demand, and geopolitics. First up, let's talk about currencies, specifically the US dollar. Think of the dollar and silver like they're on a seesaw. When the dollar goes down in value, it usually takes more dollars to buy an ounce of silver, so silver's price goes up. Conversely, a strong dollar can put pressure on silver prices. This inverse relationship is a classic one in the precious metals world, and it's always something to keep an eye on. Next, we have interest rates. This one's a bit more behind the scenes. When central banks, like the Federal Reserve, raise interest rates, it makes holding cash in a savings account more attractive because you earn more interest. Silver, on the other hand, doesn't pay you any interest to hold it. So, higher rates can sometimes make silver less appealing to investors compared to other assets. Lower interest rates, however, can have the opposite effect, making silver shine a bit brighter. Now, for my favorite part, industrial demand. Unlike gold, over half of all silver is used in industry. It's in your phone, your solar panels, and your electric car. This industrial component is a huge driver of its price. As technology advances, and we push for a greener economy with more solar and electric vehicles, the demand for silver is expected to grow significantly. This unique dual role as both an investment and an industrial metal gives silver a really interesting dynamic. Finally, we can't ignore geopolitics. During times of global uncertainty, whether it's political instability or economic turmoil, investors often rush to safe haven assets. Silver, along with gold, has a long history of being seen as a store of value when other markets are shaky. So, any major global event can send ripples through the silver market as people look for a reliable place to park their money. So there you have it, a quick look at the major forces moving the silver market. It's a complex dance between the US dollar, interest rate policies, massive industrial demand, and the global political climate. Understanding these factors is key to understanding where silver might be headed next. If you found this breakdown helpful, hit that like button and subscribe for more content. Thanks for watching, and I'll see you in the next video. When silver finally begins to move in a meaningful way, it rarely happens without warning. The warning signs are not found in headlines or social media trends. They appear in stress points across the financial system. Understanding these signals is not about predicting the future, but about recognizing when the balance of risk is shifting. One of the most important indicators to watch is liquidity. Silver tends to struggle during sudden liquidity shocks, when investors are forced to sell whatever they can to raise cash. Historically, these forced sell-offs have often marked the final phase before silver begins a stronger, more sustained move. Another key signal comes from the relationship between silver and gold. When confidence begins to fracture more deeply, silver often starts to outperform. Watching the gold to silver ratio can provide insight into where the market is in that cycle. Physical silver does not behave the same way as paper markets. Its constraints are real. As trust in financial intermediaries weakens, access to metal matters more than exposure to price. Silver does not need panic to perform. It needs pressure, imbalance, and time. And when those conditions persist, the response is rarely subtle.